Good afternoon, everybody, and thank you for joining us today. I'm Paula Ruoholranta, moderator of the webinar discussing the future of the industrial sector, infrastructure, and the global forces driving change. Before we get started, I wanted to remind you that today's session is being recorded, and a link to the recording will be made available within the next few days. You can submit questions on the panel, and the copy of the presentation is in the handout sections of the panel as well. Our presenters today are three of our equity analysts, Chris Kuiper, Varun Venkatraman, and Elizabeth Vermillion. We are very excited to go through this presentation, given all the challenges that the world is facing today. Next slide. We'll start with short introduction to CFRA, after which Varun will kick off with an overview of European industrials. After we look into Europe, Elizabeth will talk us through US industrials. And to close off, Chris Kuiper will give an overview of our research methods. Next. CFRA delivers differentiated and actionable research across a range of investment services and solutions. We use proprietary method that blends forensic accounting and fundamental research to enable investment professionals to analyze industries, companies, and funds of their interest. Our global subscribers include leading institutional investors, wealth advisors, as well as corporates, academics, and governments. Through our fundamental research, we apply unique, independent, and proprietary STARS research method and deliver long-term outperformance and differentiated idea generation. We also offer forensic accounting research, which is used by some of the largest institutional investors to identify companies who are using creative and aggressive accounting techniques to mask the operational deterioration of their business. Next. CFRA has a strong reputation as an independent research company with over 90 years of innovation and growth. Today, it includes forensic accounting research, along 4 years ago acquired S&P equity and fund research, and we more recently acquired the first bridge data that gives us enormous capabilities for ETF data. With over 75 analysts, we are one of the largest independent research companies globally. Next. Blending fundamental equity research and forensic accounting gives us a very unique way to look at the companies. And as the ongoing pandemic brings uncertainty to the global markets, CFRA analysts and strategists remain focused on delivering exceptional research insight. Chris will cover this unique method in more detail towards the end of the webinar. When we blend these two powerful methods, it enables us to leverage our research through lots of different areas you see on the left, related to markets and strategy, market commentary, our sector and industry research, distilling it down to ETF and mutual funds. And our coverage on company research includes over 1,500 companies, which we cover qualitatively. We also do deep dives in terms of diagnostic industry and company monitoring for risk assessment. Next. Ultimately, CFRA puts all its resources to research. Many independent research providers claim to be free of conflicts, but they are not. We're 100% focused on fundamental independent research and feel that this is very valuable for our customers to help them with their portfolios and asset management when they can trust us to make even those tough strong sell ratings when necessary. Next, I'll pass on to our senior equity analyst, Varun, to talk through our European industrials.
Thank you, Paula. Good morning and good afternoon, everyone. Thank you for taking the time to attend this presentation. I'm Varun Venkatraman with CFRA Research in London, and I'll be talking about our outlook for the European industrial sector. I'll go through recent macroeconomic issues in Europe and UK that I think changed the operating environment for industrial companies. After that, I will dive into industry trends, which is automation, electrification, and combating climate change. I will conclude by talking about how these themes tie into some of the companies that we research at CFRA. Right. It's worth starting with a recap of what the European Central Bank has done in the past, as the last few months has seen a real change in the approach. In the last decade, Europe applied an extremely accommodative monetary policy, as you can see from the chart on the left of deposit rates. Bear in mind, this was prior to the COVID pandemic, where interest rates reached a low point of negative 0.5%. But it appears to us that the ECB has recognized that interest rates can only be dropped that far, and beyond that, it just stops working when it comes to stimulating growth. And then as the pandemic worsened back in May of this year, the ECB proposed a stimulus plan which targeted spending, and we think that's really important because the ECB has worked out that the only way to drive growth from here is by spending more money to ultimately boost demand. So targeting this, the European Commission decided on a budget of about 750 billion euros, known as the Next Generation EU Initiative. So this 750 billion is to be deployed over 2021 and 2022. About half of this is via grants, money that doesn't need to be paid back, and most of it's focused towards the southern member states who are struggling more than the northern members. So looking to the chart on the right, you can see the grants relative to GDP. It's a meaningfully large amount, 8% for Portugal, 9% for Greece, about 4% for Italy. And this is important because it's a decisive shift by the European Commission, because for the first time in a decade, there's actual fiscal coordination amongst member states. So to see the entire bloc come together for the first time, we think it changes the outlook for a lot of companies because growth now becomes even across all the member states. So why is this so important for the industrial sector? I'll get to that on the next slide. So the Next Generation EU Initiative, this is the 750 billion stimulus plan. For member states to receive that, they have to spend it on specific areas. This is laid out in the investment mandate. The 7 categories on this page, on the left-hand side, they're part of the investment mandate. It's worthwhile going through these 7 points to get an idea for why this sets up a long-term foundation for the industrial sector to prosper. So Power Up, that's a measure for member states to spend on clean tech and renewable energy. Renovate is about improving energy efficiency by focusing on insulation, glass, climate control, refurbishing buildings. Recharge and Refuel focus purely on electric vehicles, both for public use as well as individual use. Connect is about hardware that supports digital infrastructure. Modernize is automation of things like public registries. And then Scale Up. This is really interesting because it's a focus on strengthening the competitive advantage of the entire European industrial sector by focusing on things that they're good at, like advanced chip design and protecting the intellectual property behind the design of robots and so forth. Reskill and Upskill, that's about training workers for future jobs. So you'll notice these are very focused, explicit initiatives on spending to modernize infrastructure, reduce emissions, promote new tech, especially in the industrial side, and plan for the future. We think these initiatives will benefit a number of industrial companies that we research at CFRA. But there's another clear theme emerging here, right? It's not just the focus on improving and growing the economy to recover, but a priority on fighting climate change. And I'll talk about that on the next slide. So out of the Euro 750 billion plan, the EU Next Generation Initiative, about 30% goes directly towards reducing emissions. But that's just the start. The next step is the European Green Deal, and it's a rather large deal. It aims to make Europe climate neutral by 2050, and the budget for that is 1 trillion to be spent on projects over 10 years. So basically 100 billion a year for the next 10 years will be flowing through to existing industrial companies combating climate change, as well as most likely new winners that will emerge in the market. So when considering what can be done to combat climate change, specifically from the perspective of listed industrial companies, I think it's worthwhile considering where emissions come from. Looking at the pie chart on the right, you can see the energy industry. This is your traditional oil and gas. That contributes about 29% of emissions. This is already being fixed, as many of you might know, and wind energy has grown tremendously all across Europe and the UK. But that leaves other areas. So going on to the next slide, the gray part of that chart, fuel consumption. Sorry, if I could go back to the previous chart. The gray segment, fuel consumption for 26%. That is everything from heating and lighting in buildings and homes to construction activity to industrial processes, hot water supplies, things like that. a lot of investors seem to focus on areas that first come to mind when people think about emissions, right? And that's almost always energy production. But 26% is just from everyday use that we don't often consider. And there are industrial companies right now that are succeeding in reducing these emissions by improving insulation, making more efficient power plants, reducing wastage of energy, or even by using advanced hydraulics. But it's not just Europe, right? We see this all across, even more so in production-focused economies, the largest ones, specifically India and China. And I'll talk about why Asia matters to European industrial companies on the next page. So the Chinese government, we believe, have demonstrated that their war on pollution goes beyond just words. For example, a pledge to cut carbon dioxide emissions per unit of GDP by 46% from 2005 levels by 2020 was already achieved by 2017. And they got there by imposing policy restriction on factories in heavy pollution areas in the industrial northeast. We're starting to see more of this spread outside of the northeast of China into other areas. And so basically they're focused on building cleaner energy infrastructure, supply and distribution networks. Having a less pollutive energy source is only half the problem, but getting this energy then across huge geographical areas is a large challenge. And that's where European industrial companies come in. They have the ability, the technology, and they've done it for several decades of helping build out these huge networks. That chart on the left, European goods exported to China are growing at about 3% a year, while services are growing at about 6% per year. We think the services part is really interesting. It's growing twice as fast as the goods. And the reason for this is, as industrial technologies improve, it's not just the equipment being sold anymore, it's essential service revenue as well. For example, some of the projects we looked at, which involve the government essentially connecting thousands of pumps to a complicated automation network and then processors running an entire wastewater facility for a city with over 100 million people. Those kinds of projects start to provide long-term service contracts for European industrial companies. Quite often these contracts are 20 to 30 years. And at the company level, we're already seeing the benefits of trade with China. When we look at order books, Siemens Digital Industries on the chart on the right, it caters to a wide array of end users, from drone design to commercial printers to the tech and fitness trackers like your Fitbit and Apple Watches. They had about 4% order book growth in the third quarter of 2020 just from Asia Pacific, which is remarkable to put in perspective, considering that orders from Europe and North America declined between 5 and 20%. Similar theme played out with ABB, with the Advanced Robotics Division. Vestas, the wind turbine manufacturer, had an amazing 476% growth in Asia Pacific. So far I've looked at Europe and China, and I've largely ignored the UK. And the UK will be separating from Europe by the end of this month. So it's worth considering what's happening there to policy and economic recovery during this pandemic on the next slide. The UK has had a decade of austerity, and the result has been severe cuts to healthcare, infrastructure, education, emergency services, local level spending, social welfare. But in response to the pandemic, the first thing the Bank of England did was to cut rates from 0.75% to 0.1%, but they stopped there. The BOE appears hesitant to take it into negative territory, and we think it's because they've realized that monetary policy can only go that far before it stops working. And the UK is starting to show signs of embracing fiscal stimulus, just like Europe. Looking to the chart on the right, the UK was quick to react to the pandemic, ensuring people didn't go jobless and their salaries are not completely lost. That's the very bottom of this chart. So that's about 18 billion. But it didn't stop there. And that's the first clue to our thesis that fiscal stimulus may be arriving in the UK, and it's going to bring forward several infrastructure projects. So the next priority from the government was smaller projects between 1 billion and 10 billion. They were brought forward, and this is quite a different step compared to prior years where they were more worried about a national deficit. But it's not just the willingness to spend, right? It's also how the money is being spent. So notice the focus on things like public sector decarbonization and green homes grants. They're very focused on reducing emissions, a lot like Europe. So this is interesting to us because it's not just the response to the virus, but even before that, the UK government was emitting what we view as strong signals towards a shift in policy. Moving on to the next page, I'll talk about that. The items in this table are some highlights from the UK budget before the extent of the pandemic was realised. This was back in March 2020. So it's temporarily out of focus as the government deals with the emergency on hand, but we think there'll be a renewed focus on this in 2021. And looking through the items on the left-hand side in the budget allocations, building hospitals, building rail networks, building social housing, electric vehicle charging points, these are quite high-value ticket items that we think will all flow back to ultimately help the industrial sector. It really is similar to the Next Generation EU initiative we looked at earlier, the Green Deal as well. So far I've talked about what I believe will be the key drivers. This is fiscal stimulus in response to the pandemic, decarbonisation efforts, policy change in the UK and China as well. And I think it's helpful to boil this information down to some key themes within the sector and then look at how and when they may play out. With that, I'll look at that in the next slide in greater detail. So this is our roadmap for the key themes we expect, how we expect them to play out, and when we expect them to occur. Starting on the left side, in the short term, I believe the main drivers of improvement will be a short cycle inventory width. This happens because there's a lot of end users right now who have delayed their orders for inventories, especially during the pandemic. These are the replacement parts, regular maintenance, and these were cancelled or delayed just to save cash or because their productions were shut down during lockdowns. So as these start to slowly open back up, we believe they'll have a sudden boost in demand for urgent parts that they have essentially ignored over the last 6 to 9 months. So we expect most of that to flow through in about Q1 and Q2 of 2021. Other items over the short term to play out, we think will be the resolution to Brexit. And now that the US elections have occurred and there's some stability, we think companies there will be able to return to growth as well. Moving on to the medium term, this is 2021 to 2023. We expect the fiscal stimulus that we talked about to start flowing through. So this is the 750 billion EU initiative, as well as the UK's budget, as they start focusing on things like renovating public buildings, growing existing rail networks, and so on. We also think demand from Asia will continue to improve. And as the cycle turns, as we exit this recession, demand increases from all over the world should start coming back in. Which brings us to the long-term outlook beyond 2023. So earlier I'd mentioned 1 trillion set aside by the European Commission to combat climate change, about 100 billion a year. That's going to essentially play out from 2021 through to 2030. And then of course there's automation and electrification, and that's affecting everyone from heavy industries through to smart household controls. And finally, there's a lot of new concepts in the early stages of research and development, which will eventually start to play out, and we'll learn about them as they go along. So now that we've looked at how these concepts tie together, on the next slide, I'll try and go through how we think about them on a company-specific level. So we've seen the roadmap of how much, when, and from where demand is expected to flow through to European industrials. I'll look at these companies and look at specifically where we expect them to gain from the perspective of the end users in driving demand. ABB Limited, looking at their end user demand, it's automation, electrification, energy efficiency, and transport. A lot of it has to do with advanced robotics in factories, right from vehicles through to power stations. And I'm thinking about all those terms. I've covered almost all of them in the stimulus measures that are being targeted in both Europe as well as the UK. Moving on to the next name on that list, IMI PLC. It's a London Stock Exchange listed company that we think goes under the radar of a lot of international, even local investors. So IMI is much smaller than some of the other giants on this page, but we think that smaller specialty space is what often gets missed. And by being able to operate in specialized engineering, they cater to areas which are often not profitable for larger competitors, but they're able to get away with, and with quite high margins because they're much smaller. So for example, in 2020, they achieved record growth in their medical segment by making essential ventilators that are used to treat COVID patients in ICUs across most hospitals in the UK. But it's not just the healthcare items. IMI focuses on manufacturing hydraulic components that go into bigger products, right? And we think that's really interesting because quite often you have something larger, like a huge power station or another company or an aircraft manufacturer, which is a bigger process. And they rely on something much smaller, but is absolutely essential for their process, and they just can't do without it. And IMI fits into those kinds of areas. The next one on that list, company de Saint-Gobain, leader in building materials, insulation, glass. I've talked quite a bit about both the UK and Europe setting aside budgets for renovation of public buildings, basically to make them more energy efficient. Going back to the grey slice of the pie chart, the 26% in emissions, cutting down on that, and Saint-Gobain makes material for that. Next one, Siemens. I talked about their digital industry earlier. They have a wide variety of end users, from drones to factory design. So with names like that, investors start to get really diversified exposure across what we see as multiple fronts of the future in industrial technology. Moving on to DCC PLC. It's a distribution company that has diversified segments with high levels of revenue growth by being the middleman between suppliers and end users, quite often who are closer to the retail side. Part of their portfolio is a number of retail petrol stations, or gas stations to my North American viewers, which are in the process of being turned into electric vehicle charging stations. And the next one on that list is Ashtead Group PLC. It's the second largest operator of equipment rental in the US and UK, right from cement cutters through to heavy excavation equipment. So as infrastructure projects begin to increase, we expect such names to start gaining revenue. So as a quick recap, we think the industrial sector is really interesting at present. Fiscal stimulus is a new step, both for Europe and UK, and we think it will directly benefit the industrial sector. The focus on electrification, automation, infrastructure builds, and decarbonisation are likely to provide a fairly long-term tailwind to the entire sector. And with that, I will hand over to my colleague Elizabeth Vermillion, who will talk about the US industrial sector.
Thanks, Varun. So as Varun said, we're now going to look into US industrials and some of the big themes affecting the space right now. So we're going to look at the recent presidential election as well as the electrification trend and what that means for the future. So looking at slide 19, we're going to begin with a review of the 2020 election results, as this really impacts the policies that affect the industrial sector, as well as our outlook for the sector in coming years. So the president-elect is Joe Biden. He won the presidential race with 306 electoral votes versus 232 for President Trump. So on the slide here, you can see who won each state, as well as if that state changed the party that it voted for from the last election in 2016. And then every 4 years, when the presidency is up for grabs, 1/3 of the 100-member Senate and the entire House are also up for election. So this election also happens in even numbered years when there's not a presidential election. Right now in the Senate, Republicans have a 50-48 lead, but you need 51 seats for a majority. And so there's a runoff in the state of Georgia, and that will decide which party has majority of the Senate. That will be in January of 2021. And then in the House, the Democrats kept control with 218 seats to 203 for the Republicans, but Republicans did gain 5 seats there. Democrats lost seats in South Carolina, Iowa, and New Mexico. And so just overall, foreign leaders are really optimistic to work with a new president, especially regarding issues such as climate change and trade. So looking at the next slide, the election really is likely to have an impact on stimulus plans for COVID-19 recovery in the coming year. And so far in the US, stimulus plans have been really challenged by disagreements between the two parties over funding sources, the total amount of funding, where the funding is going to come from. So as you can see here, non-farm payroll, which is a common measure of the employment level, it bottomed in April of 2020, and then it started to return to stronger levels in June, but then since then it has softened again. And so we think that this really indicates the importance of another round of fiscal stimulus and funding. The first round of funding in 2020 was signed in March, and this funding was directed towards individuals, small businesses, large corporations, hospitals, and public health centers, as well as padding a federal safety net providing some funding to state and local governments and to education systems. There was cash payments to individuals, as well as additional unemployment benefits. And then there were also emergency grants and loan forgiveness for small businesses. In terms of the large corporations, most of the funding went to airlines, which makes a lot of sense since they were pretty much grounded, as well as hospitals and health centers to combat increased numbers with COVID-19. One thing that's really important to point out is the CARES Act had no infrastructure element. And if you look back to stimulus from the Great Recession in 2008 and 2009, there was infrastructure and industrial stimulus there. So that is a big difference in the stimulus plans with this recession and the previous one. So a second round of funding, is something that's extremely necessary. But again, the Democrats and the Republicans have really not been able to come to an agreement on the type, the extent, and the source of the funding, even though everybody agrees that the funding is necessary. And so there is a deadline. By December 11th, some kind of budget agreement needs to be passed to avoid a government shutdown. So hopes are that with that budget agreement, there will be some form of a stimulus plan. And then President-elect Biden also wants to stimulate. His plans for a stimulus would include more individual checks, increased unemployment benefits, and then targeting relief money to small businesses, as well as emergency sick leave and no out-of-pocket payment for any kind of COVID testing, treatment, and then an eventual vaccine. So looking at the next slide, we're going to take a look at the Democratic platform and the specific priorities that pertain to the industrial sector. So on these next few slides, you'll see in the blue bold text, that's the platform priority. And then below is a brief description of how it's related to infrastructure. So a resilient, sustainable, and inclusive infrastructure. So this calls out the need for repairing, modernizing, and expanding US highways, roads, bridges, and airports. A railroad revolution calls attention to the need to invest in high-speed freight and passenger rail systems. And this is something that will help reduce pollution, it will support job growth, and it will also spur growth in rural areas. The party platform also outlines the creation of an infrastructure bank. So this is a public bank which will lend out funds for infrastructure specific projects, and these funds are going to come from both private and public resources. We think that's a benefit. When it's coming from both public and private sources, there's a much higher likelihood for more funding. And then the Buy America and Buy Clean initiative, this seeks to increase domestic demand for low pollution raw materials. So continuing on the next slide, looking at building a stronger manufacturing base for electric vehicles. So electric vehicles are a huge focal point for both the government and for the industrial sector coming up in the next few years to the next decade. This priority is to increase the standards for clean trucking, as well as increasing market share for vehicles produced in the US. So in addition to that climate aspect and lowering emissions, the priority also wants to bring a lot of this manufacturing into the US, into US companies. President-elect Biden wants to increase the investment in all kinds of electric vehicle trucking technology, and also wants to increase the number of charging stations by about 20 times. And right now, the lack of charging stations really is a huge hurdle for electric vehicles, whether it's just cars or trucking. There's not a lot of charging stations, and so that really limits the range that an electric truck can take its route for deliveries. So increased charging stations is really going to be a game changer in the increased market share for electric trucking. President-elect Biden says that one of his first tasks in office is going to be rejoining the Paris Climate Agreement. That's something that we're looking to happen very early in January or early February of 2021. And then finally, the most ambitious priority in the platform related to infrastructure and industrials is achieving net zero greenhouse gas emissions. So the goal here is to eliminate carbon pollution from power plants by 2035. And that's a very ambitious goal. So a lot of these other aspects of the platform that we've gone through already are really going to be determinant about whether this goal is even remotely achievable. And then finally, the last one on the slide here is building a modern electric grid. So this is one of the priorities that actually has probably the most support from both parties. This was something that is a priority for the Republicans in their campaign platform as well. And so the goal here is to increase investment from the federal government into modernizing the electrical grid. Modernization means clean energy, more sustainable, and more resistant energy grids. So then moving on to the next slide, we're going to highlight some end markets that we believe are winners and losers under the Biden administration. So we're going to look at near-term winners, long-term winners, and then some end markets where we think there would have been more benefit under a President Trump second term. So in the near term, we see winners including electric vehicle trucking, where we expect more research and development to accelerate implementation into the market. We see global exporters and importers as near-term winners. We think that easing trade tensions under Biden, who prefers international cooperation, will help stabilize trade relationships as well as provide more visibility for these companies in their planning. The potential de-escalation of trade tensions would benefit exporters who depend heavily on overseas revenue, and it would also benefit domestic importers who have a significant amount of offshore production, and this is very common for heavy machinery manufacturers. And then finally, energy efficient lighting. So this is companies like Hubble and Acuity, and we expect them to see increased demand for their products where they're providing energy efficient lighting for large infrastructure projects. Some of the long-term winners include agricultural manufacturers. So with the goal to achieve net zero emissions, we think that there's opportunity for increased investment or increased revenue from them based on the large equipment products that they will sell if there is new regulation that is pushing customers into needing to purchase these new machines that are more sustainable. Companies like Trane Technologies and Rockwell Automation will also see benefits from increased demand for energy efficient buildings. And we think that, again, this kind of demand is going to be enhanced by new policy and new regulations. And then as the electrical grid is modernized, electrical equipment companies will also benefit from the improved efficiency of the power grid and its increased ability to handle power from alternative sources, which is something that right now the grid can struggle with as it's a little bit outdated. And then finally, some of the end markets where we see less growth under Biden than we would under a second Trump term, farming and agricultural commodity sellers would likely have seen more aid under President Trump. Manufacturers who have not started to work on electric vehicles, automation, or other forms of smart technology implementation, that are helping to lower their carbon footprint. So these companies will likely face rising hoops to jump through in order to be in line with new regulation and policy. And then finally, just earnings in general. In order to pay for this large green-focused infrastructure plan outlined in the Democratic platform, there's going to need to be increased government funding and likely higher corporate taxes. So now we're going to take a look at the importance of increased investment in green initiatives. So we think that President-elect Biden's election as the new president will be a win for green and emission-free technologies, such as electric vehicles. Much of Biden's policies will be directed towards directed and immediately beneficial for cars, light trucks, and motorcycles. And so as you can see on the chart here, those make up about 60% of total US greenhouse gas emissions from transportation. But the part that's most linked to the industrial sector is trucking. And so as you can see here, that is the second largest greenhouse gas contributor. And so Biden's policies and increased investment will definitely make a big difference in trucking. You know, as the technology is more reliable and sound and low cost for cars and light trucks, it's going to be easier to start applying that to trucking. So we see a lot of benefit there. We think that the increased investment will help figure out charging infrastructure as well. And that is definitely, as mentioned before, a big hurdle to making electric vehicle trucking cost effective and desirable to the customers buying the trucks. Biden has said that his policies will create about 1 million new jobs, and that would be spread across both the auto and the industrial industries, from manufacturers to suppliers and the infrastructure needed around the charging stations and factories. There are also tax incentives to stimulate electric vehicle supply and demand. These incentives would help increase the supply and the demand due to tax credits that will encourage consumers to purchase more electric vehicles, as well as manufacturers who produce more electric vehicles. And so right now, cost is a big hurdle for a company to switch to making more electric vehicles or for customers to purchase more electric vehicles. So any kind of savings in this area is going to help start increasing consumer demand. Moving to the next slide, we're going to look into how CapEx in the industrial industry is impacting demand and future trends. So on the side here, you can see two orange boxes, and those are outlining quarterly CapEx for the construction machinery and heavy trucks sub-industry within the Great Recession and then the current recession related to COVID-19. So as you can see, demand in the current recession is causing lower CapEx than there was during the Great Recession in 08-09. And we think that this lower CapEx in the current period is due to just the significant level of uncertainty in the market. So prior to the pandemic, there was a lot of uncertainty due to tariffs, trade wars. So consumers were already hesitant with their purchasing of large capital expenditures. And then with the onset of the pandemic and just the extreme uncertainty of what the future will look like and how it's been very challenging for management to plan out their budgets for the future, CapEx is one of the first places that they're putting in some stops. So this uncertainty is really driving this lower sequential quarter-over-quarter CapEx spending that you see here. And we think that this is something that could go on into the future. But new technology, battery electric equipment, this is something that might help spur a little bit more capital expenditures. This is something that, clearly is the way of the future. So if these technologies are coming to market, it might help some of the customers get back into the market, knowing that they can get ahead of maybe some of their peers if they are purchasing this equipment earlier, as opposed to just making their normal purchase of replacing their large heavy equipment where they're not really getting any kind of financial gain other than a large capital outlay. So looking at slide 26, we really forecast that implementation and the results, the benefits for the timing of platforms. So that's what we're showing here on the slide. Right now in industrials, some companies have hybrid vehicles who are available in the market, and some companies are testing battery electric trucking or other kinds of machines with hope to release those in the next few years. But either way, we think that the increased investment that will likely occur under Biden is going to accelerate timelines and lead to more battery-powered options in the market by 2024. So on the slide here, you can see some of the platform priorities as well as when we expect benefits to be evident in the market. So for tax credits for both consumers and manufacturers, that's something that we see as an immediate benefit as soon as those tax credits are passed. We see increasing availability in charging stations occurring over the next 3 to 5 years, plus even more in the years beyond that. Research in battery technology is something that is already in place and is something that we expect to be just ongoing well into the future. And on the slide here, you can also see that there are some aspects of the platform where we don't see material benefits occurring in the first term. So those are things like the railroad revolution, investing in these rail systems that will reduce pollution, and then the building a modern electrical grid. That's something where, yes, maybe there will be steps along the way, but in terms of a real material benefit, that's something that we see is about 4 years out into the future. So throughout the pandemic, there have been areas of both headwinds and strengths even in the industrial sector. And then there are some areas where there was initial weakness, but then they're really on the path to recovery now. So we're going to go over some of the areas within the industrial sector that fall into each of those categories. So in terms of strong headwinds, the industrial market was already pretty soft prior to the onset of the pandemic, and that's due to increased uncertainty on top of, as we mentioned before, tariffs and trade. So then there was also sharp declines for a lot of industrial companies in sharp demand declines due to the global shutdowns. So just complete stops in either production or ability to service customers. Service and replacement markets were also challenged by these shutdowns, but then continue to be challenged in markets where new regulations make their base businesses much more challenging. So even though they might operate in an area where there's not an actual shutdown, social distancing and just changes to the way people interact in smaller spaces or indoors really affects how they go about their business. And so that's causing a lot of pause and the need to kind of reevaluate how they just go about their daily operations. And then also pause share repurchases. So some industrials companies have resumed their repurchases, but on a whole, for the most part, those programs remain paused and will probably be paused through the end of this year. We think if a company is comfortable that they have a good manage on their costs and think that they're on the path to recovery, you can see those share repurchase programs beginning again in maybe the first quarter of 2021. So there's definitely also been some areas of strength in the industrials industry throughout the pandemic. So e-commerce is an area that really surged during the pandemic when shutdowns and additional safety measures started to shift consumer preferences to online ordering. So this is easy to think of in like a retail application, but this is also very true for industrial. So whether that's shipping of hand tools or even larger equipment, e-commerce is really an area where industrial firms have expanded. And so if you were an industrial company who already had an e-commerce presence, you already had that infrastructure and processing set up, you were able to reach your customers much more easily than peers who had to ramp up their e-commerce systems. Life sciences and safety products, of course, saw significant strength. So there are industrial companies who make coolers for transporting test samples, for transporting drugs and vaccines safely. And then there are other companies who produce oxygen products or HVAC systems, and these are required in hospitals and other essential businesses to promote safe airflow. So there's a lot of strength in companies with that safety product and life sciences tilt. Home centers and DIY products surged as everyone was staying at home and spending more time in their homes. They wanted to increase comfort, maybe do a few projects that didn't bother them so much if they were spending their workday out of the house. So you see a lot of increased demand for companies like Snap-on or Stanley Black & Decker, who are producing tools that people can use at home. And then also construction work. So construction work really didn't face too much interruption throughout the pandemic, and especially if it was a project that was already begun prior to the pandemic, those projects continued without very much interruption. And then across the board in the industrial sector, dividends and liquidity stayed pretty strong. You didn't see a lot of dividend cuts. You saw a lot of companies managing their costs pretty efficiently and aggressively. So they were able to continue to reward their shareholders through dividends, especially since they weren't doing it through share repurchases. And liquidity, for the most part, has been strong. And then finally, we're going to highlight some areas where, while there was an initial downturn, we are seeing material recovery underway. So a lot of the companies in the industrial sector are posting month-over-month growth through Q2 and Q3 of this year. So even if you look at maybe Q3 of 2020 versus Q3 of 2019, you'll see a big decline. But then if you look within 2020, you can see that there is acceleration. They are improving month over month. So that's a good sign going forward. The pandemic has also aided many manufacturing companies in rebalancing their production levels and inventory levels. So both of these levels were getting pretty out of balance with the dealer and the consumer demand. Demand was falling well below production and inventory levels. So normally, if a company is lowering their production levels, investors see that as a negative. They see that, something went wrong, there's a demand issue, or there was too much production. And so an investor would frown upon that if they saw a company doing that. But due to the unprecedented nature of the pandemic, companies have been able to lower their production levels without getting beat up by investors. So that's been something that has been a positive for a lot of companies, a lot of those large manufacturers. And then finally, we are seeing companies increase their investment in automation and technology integration. And this is something that is definitely kind of the way of the future. And some companies were further ahead than others, but the pandemic and the inability to be somewhere physically has really accentuated the need for digital communication with either customers or with their products out in the field. So that's an area where we're seeing a lot of investment and expect to continue to see that going forward. So then on this final slide for the US industrials, we're going to highlight just a few of the companies that we think are most closely related to the themes we talked about today. So here you can see that we will cover the end users that these companies service, as well as the regions they manufacture and operate in. So a little clarification on confusing terminology. These are all US listed companies, and the geography is global, meaning they operate or manufacture and sell their products all across the world. And then the US specific companies have the large portion of their revenue driven from their US sales. So companies like Caterpillar, Cummins, and PACCAR are part of the construction machinery and heavy truck sub-industry. Acuity and Hubbell are electrical equipment companies. And then Jacobs and Power, which is Quanta Services, those are construction and engineering companies. So with that, I'm going to turn it over to Chris, who is going to talk about our research methodology.
Well, thank you, Elizabeth, and thank you again to everyone joining us today. So you've heard from Elizabeth and Varun about the sector level as well as company specifics. We wanted to take just a few minutes to go over and step back and look at our research methodology, especially for those who may be new to CFRA. So starting out, giving you an overview of our equity research service. Our proprietary research employs a 5-tier ranking system. You can see on the right there, all the way from 5 stars as a strong buy to 1 star, a strong sell. And we qualitatively cover nearly 1,600 names. And when we say qualitatively, we mean analysts are actually reviewing these names, following them closely. They're building valuation models. They're covering every earnings release. They're going through the transcripts or listening to the calls, and they're staying on top of every development. This is not a quantitative coverage where it's just spitting out a report. We do cover names quantitatively when we don't have analyst coverage, but these nearly 1,600 names are covered closely by all of our analysts here. To give you a high-level overview of our methodology, one of the unique things we do is we place just as much emphasis on the industry analysis as we do a company analysis. And this is because we don't think companies operate in a vacuum, but you really have to look at the entire industry and the value chain. And many of our analysts cover a few different industries, so they're able to take developments in one industry and see how that's going to affect other industries down the value chain and gain insight or alpha from this analysis. Moving on to our methodology foundation principles, we are focused on generating alpha or actionable ideas that are going to beat a benchmark or provide excess returns. And we do that using an expectations framework for our recommendations. So the starting premise of this is that equities derive their value from expected future cash flows. This is not controversial, of course. However, we do think many investors forget that when they purchase shares in a company, they are not just purchasing a part of a business, but they're actually buying into a set of embedded expectations about how that company is going to perform in the future. So our analysts then assess those expectations from a very neutral standpoint. We then analyze what we think of those expectations, whether we think they're too high or too low, whether investors are being overly optimistic or pessimistic. And if we think that gap between expectations currently embedded in the price and what we think is actually going to happen is large enough, well, then we have a variant perception and an opportunity to capture some alpha. An example on this slide is going to make this a little more clear. For example, if you have a stock trading at X dollars per share, we then take that price and kind of do a reverse DCF or reverse engineer it to see, well, this implies 5% revenue growth and operating margins are going to expand from 30 to 35%. From there, we then can assess the reasonableness of this. Notice that as an independent research company, we don't have to take sides at this point. We just want to first assess what is the consensus view. Then we use our industry analysis and we might say, well, that revenue growth is reasonable based on addressable market growth analysis, but those expanding margins are probably unlikely given that we have rising input costs and low bargaining power. From there, we'll use our valuation analysis to determine the expected value or what we'll communicate through a target price. And then from there, we'll say, okay, is our target price and the current price far enough apart that we think we have an opportunity for excess returns? And that in turn is going to lead our stars rating and recommendation. So one of the questions we get with this on the next slide here, you'll see, what is our investment style? Our investment style is not something like value versus growth. We're actually agnostic to these typical styles. We think instead you should be looking at every individual company on the matrix of fundamentals versus expectations. For example, you can have companies with very strong fundamentals, but they could be a terrible investment. The company needs to exceed those very high expectations that are already priced into the share in order for you to do well. Conversely, you could have a company with very weak fundamentals. The company's doing awful, but it could turn out to be an excellent investment because those expectations are so low and we think the company can exceed them. Turning to the next slide, getting into industry fundamental analysis specifically, here's just a chart that kind of lays out how one of our analysts looks at the IT services sub-industry. And again, we put a lot of emphasis on analyzing every part of the sub-industry and how it all works together in order to drive a lot of our analysis on the individual companies within that. This does culminate into 2 regularly updated products that you can see. We have 53 industry surveys that are updated twice per year. These range anywhere from 30 to 50 or 60 pages apiece. And then we have our very short one-page sub-industry outlooks that are provided on every one of our stock reports. These are updated at a minimum quarterly, and we give our sub-industries a positive, negative, or neutral rating as well. Turning to the next slide, you can see just a few of the tools we use in our industry analysis. We use life cycle analysis, whether a company is mature or still growing. Porter's 5 Forces is another staple. Notice that we actually include this in every survey. We don't just pay lip service to this and say we do it. You can see our work and how we analyze each industry through this lens. We also don't just pay attention to one force, the rivalry among existing firms and what a lot of people focus on as moat. We think that's very important, but we also think the other 4 Porter's forces are also equally important. Things like bargaining power of customers or bargaining power of suppliers. Another interesting one we use is profit pools. This tool allows us to look at a sub-industry and lay out where the profits are. So for example, you see the chart on the right there, the horizontal or x-axis is the share of revenue, and then the vertical or y-axis is the operating margin. So Elizabeth just talked about the machinery industry. So here's how it would look at a sub-industry level. And we can look at this over time and see how these profit pools change, who's taking a bigger chunk, who's losing profits, and where those pools might go in the future. Turning now to company fundamental analysis, we have a macroeconomic analysis overlay from our strategy team. And then for each individual company, we look at public information, we do a specific company review, a 3-statement proprietary financial analysis, and then finally, we look at management and governance. Overall, I'd say we pay particular attention to balance sheet and cash flow assumptions, as we find it is a better predictor of returns rather than looking at only the income statement and earnings growth. Getting into company valuation, we do not follow a one-size-fits-all approach. We think you need to apply the most relevant valuation technique to the company and industry. So this can be different for every industry, such as REITs, for example. I cover a lot of real estate. They have their own wrinkles, or financials, for example. We also think you have to change the valuation model depending on the narrative of the stock or how investors are looking at it as well. And then we also use multiple methods to triangulate around it. So relative valuation, discounted cash flows, as I mentioned before, or some of the parts for a more conglomerate company. Finally, we put a risk mitigation over all of this. 3 main tools we use here are our analyst risk assessments. This is a low, medium, or high risk assessment given to each company that you'll find on the stock report. This is focused on going concern, cash flows, and balance sheet. It's not stock related or volatility price related. We also have our forensic accounting team, and we receive all the forensic accounting ratings, and our analysts are automatically alerted when companies fall into forensic accounting high-risk categories, and then they're going to have to do some more work to figure out what's driving that rating and whether or not it is a concern. And then finally, we have sector meetings where analysts must present and defend the recommendations. They focus on the risk-reward profile, and this really leverages outside perspective to reduce our cognitive biases. And then finally, wrapping up our time frame and catalyst, this is a question we get. You know, fundamental analysis we do think takes time, at least 1 or 2 years. We do communicate our expectations through a 12-month target price. And we think this longer term horizon produces not only better performance, but it also minimizes trading costs and taxes for our clients. We do also identify catalysts as part of our investment thesis to assist in the timing of our recommendations. And those catalysts can be for both buy or strong buy recommendations, as well as catalysts that might cause us to change our opinion on sell or strong sell recommendations. So with that, I'm going to turn it back over to Paula now.
Thank you, Chris. Could I have the next slide, please? On the left-hand side, you can see our coverage numbers, and our key focus this year has been our European expansion. We've added 2 experienced equity analysts in our London team, increased our qualitative coverage in Europe by 55 stocks since January, and are currently on track to cover over 95% of the S&P 350 by the end of this year. This concludes our presentation on the topic today, but I would like to remind you of the upcoming 2021 Outlook webinar on December 16th. So thank you for joining us today, and we would now be very happy to take your questions, which you can type into the questions feature panel. We had a few questions sent to us earlier today already, or when Varun was speaking. So I think, Varun, the first question was for you that came in. The person asked that you talked about fiscal stimulus helping the industrial sector. Do you think it will help some sub-industries or companies more than others?
Yes, absolutely. I expect the flow of money from fiscal stimulus into infrastructure to help the entire industrial sector, but not every member of the sector is going to win equally. I think that's where the detailed analysis of where and how much a company can gain, especially by each operating segment, and how much the market is expecting it to gain, really comes in, the expectations framework that Chris just talked about. So some of the larger companies that lead the way in new industrial tech, they have a great track record and could potentially win big. Some of the names I talked about in automation, electrification, and the robotics side. Some of the smaller companies, on the other hand, that don't compete on the same field as the larger ones, but are much more specialized, they're likely to be winners too. And then other companies like distributors or even rental companies, depends on what's happening in the market at that point. Depends on the rental costs, how much margin they're gaining, how much they've spent on expanding, and so on. So yes, in answer to your question, some companies will be much better off than others due to all the stimulus, and that's likely to change as the cycle evolves as well, as new competition appears on the horizon.
Thank you, Varun. We have 1 minute left. Elizabeth, there was a question for you, very quick one. When do you think the everyday person might start to notice electric trucks out on the roads?
Yeah, okay, thanks, Paula. So right now, there are some pretty significant hurdles. The pricing, as we mentioned, the battery that's going to power a heavy duty truck is extremely expensive still. So that cost is going to need to decline for these to really make a dent in the market. And then the other main hurdle is charging. Long haul trucks really need charging availability all along their routes. And that's something that just isn't available yet. So I think that you will start to see some funky looking electric vehicle trucks out on the big highways, at least in the US. Within maybe in the next 3 to 5 years, you would start to see a few. You would not notice that as the main kind of truck on the market yet, but it's definitely something that if that charging infrastructure starts to be more widespread, you will see a few companies who have those trucks already. They'll be pushing more and more out into the market. So I would say 3 to 5 years, and there's a chance that you'll start to see those out on the highways.
Thank you very much, Elizabeth. That's all the time we have today. So thank you again for joining us for the session, and we look very forward to seeing you in our upcoming webinars. Hope you have a lovely evening. Thank you.